In this video, we will explore the introduction to securities and securities market. We are going to break down what financial claims are, how the market functions, and look at the important regulatory definitions you need to know. Let us start with the basics. What exactly is a security? Simply put, securities are transferable financial claims or contracts. They act as evidence that someone owes a debt or that someone owns a share in a company. Think of it as a bridge between two main parties. On one side, we have the issuer or party A. These are creators and borrowers like businesses, the government, or financial institutions who need to raise money at a cost. On the other side, we have the investor or party B. These are individuals or entities with savings who want to convert those savings into assets that provide a return. So, the goal is to align the needs of the issuer with the investment goals of the holder. Now, how does this exchange actually happen? It works through a specific market mechanism that ensures liquidity and transferability. It starts with step 1, the primary issue, where the issuer raises long-term capital by selling securities. Then comes step 2, the transfer of rights. This is where the secondary market comes in. It allows an investor to transfer their interest to another investor without impacting the issuer at all. This leads us to step 3, liquidity. This mechanism allows a long-term security to essentially become a short-term asset for the investor because they can exit the investment whenever they prefer. This system is vital for what we call market efficacy and resource allocation. Imagine a pipeline. On one end, you have idle resources or surplus savings from people who have money but nowhere to put it. The securities market acts as the channel that aligns these buyers and sellers. It moves those funds to the other end where they become productive investments. This efficiency means you can buy or sell at close to market prices. It provides a dual benefit. Savers get a wider universe of options to invest in, and issuers get broader access to the funds they need. To make all of this work, the financial market relies on 4 main constituents. First, we have the investors. These are the providers of funds and the buyers of securities. Second, we have the borrowers. These are the seekers of funds who sell the securities. Third, we have the intermediaries. You can think of them as the ones providing the infrastructure to make these transfers happen smoothly. And finally, we have the regulators. These are the bodies responsible for ensuring the market develops in an orderly way and that all processes are properly regulated. Let us visualize how money actually moves in this system. We have surplus income units, which include households, business firms, the government, and foreigners who have extra money. They need to send funds to the deficit income units, which are the entities that need money. There are 2 ways this happens. The first path is direct finance, where funds flow directly through financial markets. The second path is indirect finance, where funds flow through financial intermediaries before reaching the borrowers. Both paths ensure that capital gets to where it is needed most. Now, we need to get a bit technical, but I'll keep it simple. How does the law define a security? According to Section 2H of the Securities Contracts Regulation Act of 1956, securities cover a few specific things. First, they include shares, scrips, stocks, bonds, and debentures. This basically covers any marketable security of a like nature in a company. Second, it includes derivatives. These are financial contracts that derive their value from an underlying asset. And third, it includes CIS units, which are instruments issued by any collective investment scheme to investors. Expanding on that legal definition, there are more instruments considered as securities. This includes security receipts as defined in Section 2ZG of the SARFAESI Act of 2002. It also covers mutual funds, which are units issued to investors under a mutual fund scheme. Then we have pooled vehicles, referring to instruments issued by any pooled investment vehicle. And finally, we have government securities, which are issued directly by the government. Moving on, let us look at some special instruments and declarations. First, there is something called securitized debt. This is any certificate issued to an investor by a special purpose distinct entity. This entity usually possesses debt or receivables like mortgage debt, and the certificate acknowledges the investor's beneficial interest in that debt. Additionally, the definition of securities includes any other instruments that the central government may specifically declare to be securities. It is also important to know what has been recently added and what is specifically excluded. On the included side, we have electronic gold receipts. These were declared as securities via a Gazette notification on December 24th, 2021. These are electronic receipts issued based on a deposit of underlying physical gold following SEBI regulations. On the excluded side, we have ULIPs or unit linked insurance policies. Since these are issued by insurers and combine life insurance benefits with investment, they do not fall under the definition of securities in this context. Finally, let us categorize these securities to make them easier to understand. Investors in the Indian securities market have a wide choice based on how much risk they can take and what returns they expect. Broadly, we have three categories. First, equity securities, which represent ownership interest. Second, debt securities, which represent indebtedness. And third, derivative securities, where the value is derived from underlying assets. We will cover the detailed breakdown of these categories in the next video.